Taylor, senior fellow at the Hoover Institution and professor of economics at Stanford, and Diane Swonk, the chief economist at Grant Thornton. Great to have you both here. John Taylor, I'll direct that question to you. To quote Neil Kashkari, how much does the Fed have to do here?
Well, I think they have to do more. It's good they moved last week a bit, but by all calculations, the inflation rate is higher than corresponding interest rate, and so they still need to make the adjustments. I think if they do it in the kind of way Jay Powell mentioned, 50 basis points for the next two moves, and maybe more than that, I think we're at 3% at the end of the year. It should be in the right direction, but we're not there yet, and that's the problem. I think if the move is made in a sure way so people understand it, I think it will not be the damaging effect that many people worry about.
Diane, hasn't this been just as damaging? Ruling out 75 basis points has unleashed some havoc in the markets.
Well, we have seen that, but I do think the Fed is committed to getting up to at least what they think is neutral, 2 to 2.5% by year end. I'm at 2.5%. That said, we don't know for sure that that's neutral. Our own analysis suggests we need to get to 3.5% plus.
Wow.
We don't know exactly how much that doubling the pace of sort of the runoff on their balance sheet will actually have in tightening monetary conditions, and neither does the Fed. There is no consensus on how much that will amplify rate hikes, and I think that's where the context gets a little bit murky. We've already seen mortgage rates move up quite significantly, much more rapidly than we saw the 10-year Treasury bond move up, and that was because of the Fed even talking about selling some of their mortgage-backed securities. They haven't taken that off the table yet either. So we're going to see a lot of evolution in what the Fed does, and I think you're going to see our own analysis is you're going to have to see an increase in the unemployment rate above 5% before inflation settles down to 2%.
Wow.
So you're in a hard landing. No matter how you get there, it may be a hard landing over a period of time where we slowly get there or more rapidly. And that's why the Fed's so uncertain, because they're not sure about what the external shocks are going to be, additional demand side shocks, or on the supply side as well.
Diane, I must have just missed. I always think of you as more balanced, and you are. So to hear you say that we have to get the unemployment rate up to 5% here, it's pretty shocking to me. I mean, is that what you think is being priced into these markets? We're talking about an increase from the current unemployment rate to what you think is necessary. That has never happened without a recession.
It's going to be quite difficult. And when the Fed chairman says that there's a path that theoretically could get us where supply and demand magically meet, particularly in the labor market, there is a path that it could happen, but that's a pretty narrow path. And I would argue it's unpaved and full of potholes. And when you're putting the balance sheet in reverse on top of that, that's kind of like akin to driving with the rearview mirror without any cameras in the back of the car. So you just don't know what kind of obstacles you're going to hit. This is a tricky operation using both levers together of the balance sheet. This is no longer the balance sheet just paint drying in the background as we saw it previously. And I think that is a big issue as well. But our issue is, listen, 11.6 million job openings, 1.9 jobs per worker. When the Fed wants to get it closer to 1 to 1,
right,
it's hard to get from here to there easily without a recession.